Hi, hi everyone, this is Will, aka Dr. Financial Literacy. I'd like to first start off by indicating that I am a political economist. I am not a financial advisor. I'm not an attorney or a CPA. I came across velocity banking when I was looking to get a first lien HELOC to pay off 3 mortgages. I was unsuccessful. I had to go back and improve my credit. Also had to improve my debt to income ratios based off of the income that I was making. So for the last 7 months, I've been just documenting how I've come across velocity banking, accelerated banking, and my own concept of velocity accelerated banking, or what I call VAB, but I don't want to confuse the situation. So what I've been doing is running a number of experiments and trying to reduce my business debt and my personal debt through velocity banking and accelerated banking. I currently have 3 properties. I do some consultant. I'm still a W-2 employee. I grew up in Savannah, Georgia, public housing. So I've had to increase my financial literacy through trial and error in general. So currently, let's go ahead and get started. This is overall a kind of recap of where I am since January of 2024. But I started the process, I think, in September of 2023 and trying to look for a first lien HELOC. All right, so currently my W-2 income is 3,390 after taxes and take home. This is the example when I started generally in February of 2024. My take home was 3,390. My average expenses were about 3,000. So I had a cash flow or disposable income of $390. In velocity banking, the idea is that you want to pay down your debt by taking as much of your income, W-2 income, investment income, whatever income you have, and place it on a particular debt, particularly one that is revolving. That seems to be one of the characteristics. 2, you want to establish a budget. So in previous videos, I put together a budget, showed you all the budget, and this is $3,000 a month was the average. 3, velocity banking entails, I wouldn't say discipline, because even if you get a mortgage, even if you get pay rent, it's all about being disciplined. So discipline is a part of it. So now, once I identified the debt that I wanted to be disciplined on in general or pay down was a Wells Fargo credit card that I had a balance of 7,590 and it had a limit of 7,500. So I was already over the limit. The credit card had an interest rate of 24.26% in February, and I think it's up maybe 1 point at 25.26%. So what I did was take my entire W-2 income in February, but I started off in January putting small amounts on it. So I may have put some of my gas, food, and insurance bill, and maybe one other bill on it. So I started off slow in January of 2023, not putting my entire paycheck on, but by 24, I'm sorry. But by February of 2024, I kind of saw the numbers, see how things were going, and I went in full force to put the entire paycheck into it and then draw from it. So with that in mind, the 3,390 of my entire paycheck went into the credit card that I was looking to pay off. That brought me down to $4,200. Now, I did have expenses that were a part of this 3,000, but now my expenses were $27.50 because the credit card that I was using, when you put your paycheck onto it, it makes the payment. So that's one of the things that velocity banking advocates, or accelerated banking advocates indicate. When you take your income or your salary, you place it on a card, you're actually making the payment for that card, and you should be able to deduct it from your payments. So now what I'm able to do, I was able to take out the 250 that was inside of here. So the 250 that was inside of here, take it from my expenses, but now add my expenses back onto the card because I was paying my rent. I was paying my all my utilities, gas, food, clothing, anything that you can name. I was paying it through the card. And whatever was remaining from this cash flow was no longer sitting in the bank. So the cash flow that I used to have, that used to sit in the bank, is $390 in the bank. I took that $390, wiped that out, and now that's a part of the card. So it's sitting there. I also liquidated my checking accounts that I had emergency funds sitting to the side, other checks sitting to the side just as an emergency fund, and about three to four, yeah, I'm gonna say about $1,500–1,600. So I took some of that, or majority of that, out of the bank and put onto the card. So the credit card, that first one, Wells Fargo, became my new checking account for the most part. I still kind of left $10, $20 or something in there to maintain the checking account because it was a part of my direct deposit. Once I received my paycheck from my employer, I used the bank to move it over to the card. So now, again, as we go back to my expenses, 250 has come off because I'm making a payment as velocity banking advocates, accelerated banking advocates indicate. And the card goes back up. So it went to $6,950 because expenses increases the card and pushes it back up. Your income decreases the card. So one of the main things, and I think number 4 benefit is that it's helping you to reduce, or it helped me to reduce the average daily balance. So whereas the average daily balance was well above 7,500 and they were charging at 24–26%, at a lower balance of 695 kind of helped to say, well, it did save interest. And that's one of the main things, is save interest. So if it saved me $10, $20 in interest above what I would have paid, then that was a win. Next, in addition to adding my expenses going back in, I had to add interest for the month. So the card was about $155.96 in interest when I got the statement. How did I calculate the interest, or how did they calculate the daily interest? So the daily interest was calculated by the average daily balance of the card. And that card was again at 7,590 above. It was above the 7,500 limit for the entire month. So I didn't go in and make one payment or two payment. It stayed the full 30 days in February of 2024. So I wasn't really using velocity banking and throwing as much into it. So 75.90 at the interest rate of 0.2426, because I converted this 2426. That gave me 1,841.334. Now, because we're in a leap year, I then divided that number by 366. Next year, it's going to be a non-leap year, so it's going to be 365. So now I take that 18,411,334 and divide it by 366, a leap year, and I came up with $5.03 per day that was being charged in general on the Wells Fargo card. So maybe this was in February. I think, okay, I'm sorry, let me look at the calendar again. Okay, so here I have 31 days, but it was 21 days, 28 days in February. So the math is off a little bit in general. I should have did 28 days instead of 31 days. I think I was still thinking about July for my HELOC. So I'm still just gonna run with the numbers. So $155.96 on interest. The interest was added back, so it pushed it back up to $7,105.96 for that particular month. So one of the things that you're looking at when I make the credit card payment, say of $250, that $250 is made up of $94.04 went toward the principal, $155.96 went toward the interest. So on the balance, and that may be another video, the principal will come down in general just by making those payments. So overall, just a kind of recap of just looking at velocity banking and accelerated banking. Previously, the system that I had was just fundamentally getting paid this so previously to using velocity banking and accelerated banking prior to January of 2024, I would pick up my check from my employer. That check would go into the bank. From the bank, I'll pay all my expenses. And those expenses included credit cards, rent, mortgages, student loans, and then whatever was remaining, that 390 that was remaining used to sit here until I got the next paycheck. Now, since starting in January of 2023, I still get a W-2 check from my employer. It is deposited into the bank. From being deposited into the bank, I now started to identify a line of credit that I wanted to pay down, which in the previous statements was the Wells Fargo Visa. Once my check went on into the bank direct deposit, place it into the Wells Fargo Visa, that 390 plus whatever I had then now remains on whatever credit card that I have. where it used to come back to the bank and sit, no more for the most part. So again, I have the bank, the checking account, but I have those checking accounts in general for kind of like small things. I still need to have direct deposit until I get an instrument that I can directly take that entire paycheck and put it on the card. So maybe I'm also looking at trying to develop a credit card where your entire paycheck can go directly onto the credit card and possibly bypass the bank and pay down the interest even quicker. So looking at how that can be done in general. So yeah, that's my system in general that I'm using. This is a system that I've used since January of 2024. Running the experiments, running various other aspects of it. It eventually allowed me not to get the all-in-one HELOC that I wanted that would have wiped out probably $150,000 in debt, but it eventually led to me getting the HELOC that I'm working with now of 50,500. So now versus the money going from my employer, my W-2 job, to the bank, to a credit card, it is now going into a HELOC. Let me see if I can diagram that. Let me see if I can create that right quick. So now I'm picking up my check, W-2 from my employer. It's going into a bank. And now is going into the HELOC. All right. So the HELOC is held by a lender in general, and I pay into it. So now I've replaced the HELOC. I'm sorry, I replaced the check with the HELOC. So now I pick up my paycheck, W-2 is deposited into the bank, and then I immediately move into the HELOC, and from the HELOC, I pay all expenses. So all my expenses are in the HELOC. So I replaced a traditional way of getting your money, bank, paying the expenses, to picking up the check, bank, a line of credit, which was a credit card, increasing my credit, improving my debt to income ratio, that I was able to get a larger line of credit, which is called a HELOC, home equity line of credit. And that's the difference between what my mortgage was, my payment, and then they assigned a value to it and gave me a percentage. In this case, I think it was about 25% of the value of the home. So since April of 2024, I've been using the HELOC to just make interest only payments until a 90-day locked out period for July. Now I can really pay everything out of it. I get checks from the HELOC, and I write a check on everything against the HELOC. And I also I have one single credit card that I put all my expenses on and then draw from the HELOC to pay it. So just as a recap, everything that I have now is more simplified. I'm running it through a larger line of credit, paying everything through that line of credit with checks from the HELOC. So my utilities, gas, cars, anything that I have, I pay through the HELOC, but I also have a credit card that I use monthly, but then draw from the HELOC to pay that off, to try to keep this HELOC as low as possible. So as stated in the beginning, I am a political economist. I look at the economy, the interaction between government, policies that are made, and then sometimes look at winners and losers of public policies. The HELOC is an industry. There's winners and losers. There's interest rates in general and what you're willing to pay. That is public policy, at least from my perspective as an political economist, and how I study these things and use these things, and then try to educate the public based on my real world experience and some theoretical experiences that I have or heard of. So again, thank you very much for stopping by, and I'll see you in the next video. Have a great morning. Bye-bye.